Welcome back to Bitcoin Season 2. I've got Peter Todd on today. Peter was recently identified as Satoshi in an HBO documentary. Now, while we know that he's not Satoshi and he denies being Satoshi, Peter has been around a really, really long time. So I've got him here in my studio, and we actually talk about Bitcoin's history, what it's looked like over the years, and how it's come to look the way it currently does. We talk about a bunch of different subjects, risks to Bitcoin mining, risks to Bitcoin users, and we even touch on some of Peter's, I would say, controversial opinions about ways that Bitcoin could look in the future. Bitcoin Season 2 is brought to you by Arch Network, building bridgeless apps on Bitcoin. More on Arch later on in the show. Let's kick it off. So I'm here at the Blockspace Oklahoma studio. We've flown Peter Todd in all the way on one of the.
Hey, I flew in. Okay, I mean,
Peter, I'm amazed you made it. Tell me how did you get to Tulsa, and why is it significant that you made it to Tulsa today?
Oh, it's really easy. I just hopped on 3 different planes that had been delayed by 2 days, and finally, at the end of it, among other things, I get to Tulsa. It's like 2 hours late, and then the captain goes up and says, "Oh, we got to wait a bit because the gates are congested." 30 minutes later, he comes, "Oh yeah, actually no, we also got to wait because the tow bar is buried in snow, and they are digging it out right now with shovels."
I mean, when you think of Oklahoma and Dallas, Texas, you don't typically think of like being, totally under snow, but here we are. It's frigid temperatures, and
beautiful weather.
Beautiful weather. Yeah, you're Canadian.
Yeah, I'm Canadian. It's not that cold. Yeah. Come on.
Well,
I'm only wearing one pair of long underwear.
Yeah, so you're in your summer clothes.
Yeah, summer clothes.
Okay, so right before I hit record, you mentioned that you don't like the word time chain.
Yes.
Why? Isn't that like what the true Bitcoiners like? Isn't that what I'm supposed to like?
Well,
that's what Satoshi used originally.
Yeah, and Satoshi didn't fully understand Bitcoin. But so the irony here is I'm founder of Open Timestamps.
Yeah.
Which is a thing to go and do timestamping on Bitcoin. And what is a timestamp? Well, it's a mathematical proof that data exists in the past. The problem is timestamping is not sufficient to make Bitcoin.
Why?
Because timestamping just said something existed in the past. It doesn't say that something didn't exist in the past, like a transaction spending your money. That's the key thing. Timestamping alone is not enough to prevent a double spend. And the word time chain gives people the impression that time is the thing that matters. Or the ordering events. No, that's not the thing that matters. What matters is the space. Because a blockchain is a well-defined thing that we know the entirety of. It's like the physicality of it. Like blocks are a thing. They are a thing with size and volume and so on. And it's a thing where you know that you're looking at the same thing as me, all of it. Thus, your node is verified that your money is real because there were no other transaction spending before. Time alone is not enough for that. And time chain is such a terrible term because it promotes the time aspect of it rather than the space aspect.
So you're a return to blockchain. This was an overused term in the, leading up to the ICO boom.
Technically, it wasn't an overused term because all these things did need blockchains. If you need prevent double spends, at some point you're going to need something like a blockchain. Now, there's a bunch of different ways to implement it, but they're all roughly blockchains. So yes, all these ICO things, they were all blockchain tech. You could kind of also say they were all computer tech.
Yeah.
And, we irrationally hate the term blockchain because these scammy things used it. But that's like irrationally hating the term computer because a bunch of stuff pops up saying, oh, computers are going to do this, computers are going to do that. Yeah, but the term is still the correct one to use.
So do you think Satoshi may have thought about down this train of thought? Because I think originally, we've seen original versions of the white paper prior to the publishing in October of 2008. I think there's a version of it prior where Satoshi does use the term time chain and then actually changes it to blockchain. I may be mischaracterizing it, but do you think Satoshi also considered this when?
Well, so final release version of the Bitcoin white paper, as I remember, says something along the lines of, the system, whatever, acts as a timestamp server, something to those
a
lines.
Distributed timestamp. I got the. Yeah, if we had time, we could look at the white paper.
Oh, yeah. Here, yeah. Number 3, timestamp server.
Yeah.
The solution we propose begins with a timestamp server.
Yeah.
That is wrong. Satoshi got that wrong. It is one of at least 2 things I think of off the top of my head where the Bitcoin white paper is not correct.
Damn, keep going. What are the other 2?
Well, the other one, and actually this is something Satoshi had to go fix, is that the Bitcoin white paper talks about the longest chain.
Yeah.
And that is not correct.
Well, we kind of, through emergent consensus or rough consensus, kind of redefined that.
No, it's not through rough consensus or anything. No, we've redefined it.
Yeah.
Because Satoshi realized he'd screwed up. And like a couple releases after version 0.1, Satoshi quietly changed the code from longest chain to most work chain. And at the time, there was no difference because blocks had gotten more than difficulty 1. But that's a very big difference for a real system. And, the reason why, like, you kind of explain it simply. Imagine if someone using very little hash power creates a really long chain. Would you switch to that chain against the current one?
My Bitcoin initial release client would switch to it, but the nodes I run today would.
Because the node you run today actually works.
Yeah, but my nodes, is actual the technical logic heaviest chain, or is it
most work?
Okay.
So heaviest is another term, but the definition of work is the total expected number of hash attempts it would take to create the chain with the current rules. And what that basically means is that at a given difficulty, a block is worth a certain amount of work. And part of why that's true is because in Bitcoin, it doesn't matter how lucky you get. You just have to get lucky enough. So, this isn't quite true, but roughly speaking, it's the sort of the number of zeros in the hash.
Yeah.
You have to have at least this number of zeros, but if you get more because you got really lucky, it doesn't matter. Now, there are other ways to do proof of work, but that's the way Bitcoin works, and it's a better way to go do it. And that's the most work definition. It's you go through all of the blocks in the chain, you figure out how many hashes it would have taken, and then you switch to the one with the most difficulty. And that's why in Bitcoin's early days, when difficulty hadn't actually gone beyond the minimum, they're the same thing. But currently, if you ran a version 0.1 node, an attacker could fool you into switching something that it costs them almost nothing to make. That's obviously wrong.
So it's a misconception, you say, that Bitcoin's release at Genesis was sufficient to participate in the Bitcoin network.
Yeah, that was one reason why it was just fundamentally broken. Now, if you run a Bitcoin version 0.1 node,
you can still broadcast valid transactions.
Well, like it's hard. Like for other technical reasons, it's hard to actually connect them to other nodes.
Peering is more difficult.
Well, because the P2P protocol, it did change in incompatible ways a few times. But there is a way of running like different version nodes, such that even today's blocks would eventually get to your version 0.1 node. And with a bit of other tweaking, you could eventually sync it. So yes, Bitcoin is backwards compatible to a degree, all the way back to 0.1. There's some nuance in that statement because Satoshi did make some screw-ups, but roughly speaking, you can make that work. But certainly the white paper does not get this aspect of Bitcoin correct. And also I got to point out, the white paper was just a white paper.
Yeah.
It didn't mention Bitcoin scripting system as an example.
True.
Right? There's lots of things it didn't mention. It gave a rough outline for how the system could work, got some stuff a bit wrong, really miscategorized things. The timestamp server language is really dumb. But, version 0.1.
So this is really interesting because a lot of the Bitcoin narrative is that Bitcoin is this perfect thing.
Hell no. It's pretty good, but it ain't perfect.
It's amazing that we've made it this far. It kind of is. It feels miraculous that we've managed to produce a blockchain that has survived today.
A lot of that is incentives, but the problem is incentives aren't perfect. We've been lucky. A good example of this, yes, another thing Satoshi did wrong was the Bitcoin difficulty algorithm means that or sorry, become block reward all means that every 4 years the block reward gets cut in half. And we've been very lucky that the profitability of mining has been such that miners were profitable at half of the revenue for the most part. Not everyone, but like profitable enough to keep their systems on most.
Yeah, it's worked very, very well.
We've been very lucky.
Yeah,
there's a different reality we could have been in.
Yeah,
where hash power could have been much close to a 0% profit margin, where after one of these halvings, just everyone turned up their hash power, and we'd be really screwed. Now, yes, you could go and try to pay fees, but there's a world where Bitcoin might have died at that point because blocks would take too long and the interest would be lost in the system. Again, Satoshi screwed this up. The sane way to do this is, if you want that kind of subsidy decrease, do it gradually. Don't do it a sudden like halving event. That's just dumb.
We may get into demurrage.
Oh yeah, that's another question.
I think we'll
look into the future.
I'm going to pin that, so we could come back to it.
Keep in mind what I just said there is nothing saying about whether or not subsidy should go away. It's even the way it goes away is just done in a dumb way. As an example, Zcash, they just hard code a table of gradual decrease, and it's fine. It's a smart way to do it, or at least not a dumb way.
So, do you think we're past that this risk to Bitcoin's hash rate and the relationship between price, profitability, and hash rate? Do you think we're past the greatest risk of that scenario happening?
Of that specific scenario, since fees have been able to get reasonably high, it's a lot less of an issue than it was, say the first halving, when there really weren't much of a transaction fees.
Yeah.
So we dodged a bullet on that. But like I say, things could have gone differently. And indeed, I mean, the fact that mining even works the way it does is something Satoshi doesn't seem to have understood.
Yeah, because I as a miner have looked pretty closely at all of the comments that Satoshi referenced, and especially when they were imagining what mining might look like in the distant future. I mean, they were directionally correct on some things, but kind of blind about others.
Well, pools.
Yeah.
Satoshi didn't seem to understand that pools would be a thing. And which also makes block withholding attacks a problem.
Yes, which we talked about. Do you think, I don't know, I don't think I've talked about block withholding attacks on this podcast. This might be an interesting topic to just jump right into right now.
Yeah.
What is a block withholding attack? Because again, the listener on this is probably on CoinDesk. They probably stumbled upon this as like, oh, Peter Todd, he's Satoshi, not actually Satoshi.
We are all Satoshi.
Exactly. But like they, the average listener might not be familiar with this obscurity, and it's some might say an active risk in Bitcoin right now. What's a block withholding attack, and what?
Well, so block withholding attacks are not an issue if you're solo mining. If you are mining for yourself, you're not involved with any other people. And the reason is, if you go find a block, if your hash power, if your S19 sitting in your garage finds a block.
I have an S19 in my garage.
Yeah. For the record, it's in the garage. Like, there's a space heater down there, and I'm very disappointed that we are being heated by dumb space heaters.
I got a BitAxe. I have an Ordinals themed BitAxe on my desk back here. So
very disappointing.
Yeah.
But so if your S19 in your garage finds a block, if you're the one who will get the reward for that block, obviously your incentive is publish that block. You publish a block, other people start building on it, you earn a lot of money. You can buy another house or just get a really big jacuzzi.
Exactly. Yeah. I don't want either of those things.
Yeah.
But yeah.
I was thinking like a $500,000 jacuzzi. It'd be cool. Yeah.
One block's reward worth of jacuzzi.
Yeah. One block reward worth of jacuzzi.
Okay. So if I'm solo mining, I publish the block. That's how Satoshi intended.
Yeah. Because Satoshi didn't seem to really predict pools would be a thing. So what is a pool? Well, in the case of a pool, it means you and I and 1,000 other people get together, and rather than you mining a block that would pay you, in something like, say, the Ocean model, you mine a block that would go pay all of us. Or even just you would mine a block, like, so let's say I'm running the pool, you would mine a block that pays me directly, and then I promise I'll then pay you back. And notably, the way it works in reality is because you can't deal with variance because you got a power bill to pay, I go pay you per share. Every time you submit a partial hash solution proving that you were working on Bitcoin blocks, I then pay you a little bit. But what if you want to make my pool fail?
Yeah, what if I'm a competitor?
Yep.
Or let's just say I am just selfish in general.
Yeah. You're an asshole.
Yeah. True.
You can point at hash power at my pool, and then when you find a block, you just don't tell me. And there's not much I can do to prevent that.
Because to the pool software, it looks like I'm just submitting shares occasionally, and I happen to not find a block.
Yeah. If I did the work to check your shares, I would be the one doing the mining.
Yeah.
Right?
That's true.
This is just a fundamental, unfixable problem with Bitcoin unless you want to do some pretty significant changes to how the protocol works. Now, this is possible with hard fork. We can fix this with hard fork, but it's an ugly hard fork. And
do you think this, before even explaining the fix, do you think such a hard fork would ever be worth it?
A problem with block withholding attacks is it's hard for us to know if they're happening. And pools like Ocean, where hashers are meant to go and create their own block templates, are actually more vulnerable to these.
Oh, interesting. Why?
Well, let's suppose I'm a sort of quote unquote traditional pool, and all you do is you receive the block information, the bare minimum,
block header and hash of the
bare minimum necessary to go and mine. If I'm giving you the bare minimum, I can check that you're doing a block withholding attack in certain scenarios by giving you a previously found block solution. And then I check if you reply back to me with a found block. Now, this was possible in certain cases, and like how I'd have to double check. I think current mining protocols, it's a little sketchier if you can actually do this, but this is certainly a way to go fix this problem. But if you're creating the templates yourself, there's nothing I can double check your work with.
Okay. Yeah. Yeah. Okay. Yeah. I think I understand what you're saying there.
Yeah. So now, a P2 pool, which was sort of a decentralized pool.
OG pool, not.
Yeah. Technically, it's still running, but it might find like block a year.
Yeah. Okay.
Yeah. For technical reasons, it's not really compatible with current Bitcoin, and that gets down to like how Segwit is and a bunch of other stuff. But back in the day, I used to mine on P2 pool.
Yeah.
And P2 pool has a very clever solution to block withholding, which is when you find a block, you get a special reward. So now, if you do a block withholding attack, you're giving up, say $10,000 per block you withhold. That's not the full value, but at least it's some incentive to publish.
So it just makes the cost of block withholding more to the attacker, as opposed to now where it's just asymmetrically in the attacker's benefit.
Yeah. And the challenge is, yes, all pools could implement this. It'd be basically a bonus for being the guy who found the block. The problem is, imagine a scenario where, I'm running a small pool in a much bigger pool, say Ant Pool, doesn't like me, just wants to kill my business. They may be willing to pay money to do a block withholding attack just to screw me over.
Especially because, we, as we talk to the actual the mining operators, the mining operators are pretty much exclusively profit driven. In fact, they're almost so far removed from the ideological parts of Bitcoin that they may be considered purely profit driven actors.
Yeah.
So Ant Pool, or say the larger pool, could know that some of its potential clients are pointing to the smaller pool, or maybe they're gaining market share. The larger attacker pool could try to bankrupt the other pool.
Imagine this is like government regulation scenario.
Yeah.
Some government says, well, I don't want hash power to go to this like anything but the AML KYC pools. They could start doing block withholding attacks. And for them, this is just a matter of budget. Like, they're willing to go and spend the money to do it.
Yeah, nation state block withholding attacks.
Yep. Now, there is a way to go fix this. And this is something Bitcoin could have fixed from the beginning, which is you do a 2-stage proof of work, where to make a block, you basically have to go find parts of a solution, and then the pool does sort of a second part of a solution. And it's only if they both match that it's a valid block. And why
so
this
you need each other basically to prove the block.
Why this fixes it is because you can do the first part of the problem to be the threshold for your shares. All right? Because remember, Bitcoin mining, the way it works in general is I consider a share valid when it meets a lower difficulty level. And that's the way you prove to me, the pool operator, that you're actually mining at all. Because we didn't have that, of course. You could just say you were mining, and I would have no idea.
Yeah, I'm submitting valid shares.
It's the ultimate block withholding.
Yeah.
So we get away with that by saying, well, you got to submit shares at all. The problem is, you know whether or not the shares are actually a valid block. If you don't know, because there's an additional element of luck for something only I can know, then we fix the issue.
Let me tell you about one of the most slept on opportunities in crypto. Arch is building fast, composable DeFi apps on Bitcoin. Arch apps tap into the OG blockchain with by far the most liquidity and best brand in crypto. I've known the team for over a year. The tech they're building is solid, and they are racing towards mainnet. There's dexes like Saturn, meme coins on funkybit.fun, instant loans on Cha-Ching, and so much more. Plus, they're rewarding testnet users, so join me in trying out Arch while it's still early. But devil's advocate, what's the risk of this? Because we don't actually, even though we can assume that this has probably happened and that there has been hash rate accumulated under one
Keep
group.
in mind, there's good chances happened by accident too.
Happened by accident, yeah. It doesn't seem to have affected the actual purpose of the Bitcoin network, which is to get transactions into blocks permissions.
But But I mean, you could argue Bitcoin's certainly failed to a degree, which is so much of the hash power is in the control of, depending on how you define control, like one or two entities. And pools acting as proxies for ant pool is not good. It's not completely life threatening because in theory they can go switch away if ant pool tries to abuse this.
In theory,
but I mean, if push comes to shove and we see, say, government regulation on ant pool, I am not convinced that this will actually work out the way we want it to. It may not.
Yeah, and then also consider that against the backdrop of we just met with a large operator at scale who was not really familiar with this dynamic. And they are one of the more notable operators in the region. And I think I make this point a lot, Peter, which is like a lot of Bitcoin incentive game theory assumes that all the participants know what the game is. And it does not seem to be the case where now the broader Bitcoin industry, from the mining to the investor to the developer.
I could say this another way too, which is some of the attacks we face, like government regulation, are things which can change the incentives in ways that are hard to predict and hard to defend against.
Yeah.
A good example is being like some people say, well, transaction fees are your solution to all this. But like, dude, a transaction fee is worthless if you're under government control and you can't accept that fee. And there's only so much that you can do to create these incentives. If we did visit a mining, hashing facility, and suffice to say it's large enough, I am sure anyone with a plane or access to some satellite imagery could figure out where it is.
Yeah.
Like,
the utility knows where it is. Yeah.
Like it's hard to hide that kind of install. And you can hide it by distributing it, but that's not how.
Yeah, and the previous presidential administration literally sent out a request for mines of that size and larger to file and register location, size, what you're doing, point of contact.
Now, we were lucky that, if I remember correctly,
it wasn't really fully enforced.
Well, if I remember correctly, that went to the court, the appeals court or whatever it was, and that order got overturned.
Yes, the Texas Blockchain Council, shout out Lee Bratcher, was on top of that. Yeah. They came out of pocket to to shut that down.
But in many countries, you would not have that ability.
Yeah.
In many countries, that would be completely constitutional or equivalent, or of course, many places.
Yeah, you saw this happen in Kazakhstan.
Yes.
In a year and a half ago.
Yeah. China was able to do something similar too quite a few years back. And, you know, we don't want to, like, security is always additive. We don't want to be in a position where our only options are to hide in the shadows and so on. We would much rather have many levels of security here, so that we're not always relying on the sort of the cypherpunk ethos.
But that's cool, though. I mean, it's cool. It's cool to have it.
Yeah, it's cool that you have it. I don't use it. Like, it's cool we have a military who can go to war. Doesn't mean I want to go to war. You know, sometimes you have to, but it's much better if no one does the attack in the first place. And I think block withholding is an example where we would have been much better had the Bitcoin protocol just not had this issue. Now, I will devil's advocate point out that there are people who argue block withholding is a good thing because, you know, well, then you can go take down Antpool and all that. But, like, dude, the next iteration of that game theory is you just AML KYC everyone.
Yeah.
And with AML KYC, in the fact you can do tests for block withholding to a degree, big pools have ways of preventing an attack that small pools don't, which, again, completely screws over Bitcoin incentives.
Or everyone can go back to solo mining and not be able to pay their power bills ever, which is both a pretty base thing to do, but also, like, well, I have a hard time imagining that's practical anytime in the future.
You know, this is something where our sort of vision of everyone having an S19 as a space heater.
An S19 in every house.
Yeah. Like, that only makes sense if you can go mine at pools and actually get paid for your S19. Because otherwise it's just a lottery. And lotteries are not actually that popular, especially if they require, like, an initial investment and some complex setup. Like, smart people don't play lotteries that much. Smart people run Bitcoin miners.
So let's shift gears to talk about soft forks. And I think you have been mulling around on this idea of activation, maybe.
Yep.
Like, how could a soft fork happen? This is, again, one of the focuses that I try to talk about a lot. Just launch into it. Yeah. What's on your
context? You know, I need an excuse to go to off next.
Yeah.
Like, giving a talk is the way I can have that excuse. So, but, you know, I mean, obviously, like, if you're going to go and do soft forks, which the community is all talking about, you need some actual concrete way of how the hell do you make it happen. And, you know, of course, we were talking about Satoshi in the early days. In the really early days, Satoshi would just commit code, make releases that didn't even necessarily say what had changed, and people would just run it. That was your activation mechanism.
I mean, frankly, this is, having lived through the early days of Ordinals, I love Casey, but that's kind of how Ordinals happened too. You just kind of like, okay, I'm doing the client this way.
Yeah.
And it worked out great, but there were
some interesting fuck-ups that got fixed in interesting ways.
Yes, and
that smells like Bitcoin's early days.
Those plague me to this day. But soft forks.
So I personally did a soft fork years ago, which was off check lockdown verify. And that's a new opcode, actually used by Lightning. And the soft fork process for that was what's called miner signaling. So we released a version of Bitcoin Core that said that if hash power had set the version field in their block header to, if I remember correctly, I think it was 2 or more, you would say that off check lockdown verify had activated. And to be exact, the concrete thing was like off check lockdown verify. I think it was the rules would be like enforced at like 75% of miners flagging it, and then blocks that didn't enforce it would be banned once we reached the 95% threshold. Something like that. You know, this is like nearly a decade ago, so the numbers are rough. I might be incorrect. That's roughly what it was. It was, you know, we kind of enforce it, then we really enforce it. Well, what's interesting about that process is, first of all, it was a release of Bitcoin Core. So what we're really saying is we think Bitcoin should work this way. And it's notable that there's no mechanism in what I just described that can possibly turn this off. Right? As long as you're willing to run a version of software that enforces this rule, either check lock time verify hasn't activated yet, or it has. There's no circumstance where you could say, all right, we give up.
Like a timeout.
Yes, there's no timeouts or anything like that. It is, we are basically saying by releasing the software, we are so confident this will activate, we're going to put a line in the sand and say, it will. This is going to happen. And we're kind of saying we are confident that enough other people will run software like this, that it's safe to run a node this way. Because like hypothetically, let's suppose you're the only person in the world who runs a Bitcoin Core node, or like a Bitcoin node that implements this activation. Now, let's say I propose something totally different that uses the same activation mechanism for something entirely different. If you keep on running that software, you're going to probably get forked off the network eventually, because you'll enable rules through my activation that conflict with what you just enabled, and eventually you'll probably accept an invalid block, and like weird stuff will happen. So like the lack of a timeout is interesting.
So we did try to kind of figure out how to implement this with BIP 8 and 9.
Well, let's hope I've remembered this correctly, because it's been a while since I've looked at this.
I also look at them, but I still actually have to like GPT and like verify sometimes.
Yeah. So I hope I've remembered this correctly, because I was involved in like, but again, this was years ago.
Yeah.
So I believe for check, or maybe it was for SegWit. Maybe we first used check.
I think we did. BIP 9 was added before Seg. Shoot. Damn, we maybe hit record. We should have gone and like verified this.
Anyway, at some point, we decided the lack of a timeout looked sketchy. And the other thing was not being able to have multiple proposals in flight at once. People thought that was a bad idea. Like they wanted there to be potential competition.
Wait, can't we do that with the version signal?
The version number, you can't. Well, the thing with version number is, since it's just a number, you could have multiple proposals in flight, but the problem is
each combination is a new version.
Well, they're locked sequentially, right? So if like I pick version 2 for check lock time verify, and you want to propose, say, check sequence verify, your only option is to pick the next number, which means that for your thing to activate, my thing must have activated.
Oh.
Which is technically fine, but it means we can't do something that's competing. Now, whether or not that's good or bad is a whole other question.
Yeah.
But that is the property it has. And again, I want to double check, but I believe this is how it played out with check sequence verify, which was a logical extension to check lock time verify. And Lightning also uses check sequence verify.
Yeah. We had 3 softworks for Lightning, so we could get it to work.
Yeah. Well, and to be clear, I mean, other versions of payment channels would have used check lock time verify, check sequence verify. There's many things that use these opcodes.
But these like Spillman payment channels.
There's a whole zoo of things that kind of all got obsolete by Lightning.
Yeah.
But anyway, the key thing there is, in that style of upgrade, you're ultimately releasing software that says, yeah, this is the only path it can take. Yes, it might take a while to get there, but there is that path, and that's predefined. Now, the idea with, let's hope I've remembered this correctly, with like BIP 8, BIP 9, whatever it was that you could say, we will have a period where something will potentially activate, then after some timeout, that's no longer true.
Yeah.
And what's notable about that is, let's suppose you run software that activates that way, and it's for a proposal that doesn't get traction. You can still run that software, and then someone else can make another proposal. And no matter what they do, provided the proposal happens after the expiry time, your software still works fine. It stays in consensus, right? It's still a safe soft fork.
Do you think this, some people would argue this is a good thing or a bad thing. Do you think this takes some of the taboo off of signaling for soft forks?
Well,
or maybe normalizes or makes people more comfortable with soft fork, with signaling towards one?
I think the big thing I would say is it makes it more of a vote. See, check lock time verify, you got to understand that while it looks like miners are activating it, the fact that it never turns off actually makes it more like a purely user-activated thing, right? Because let's suppose that everyone, 95% of economic nodes go and decide to run this code. They're all saying collectively, we want this thing to happen. It will happen. We will pick exactly when it turns on based on when miners say they're ready. But our assumption is eventually this will happen. It might take 3 years, it might take 5, but like the way the code works is this is going to happen. And yes, miners are sort of voting for it in a sense, as in when it will happen. But the general thrust is this is going to happen. Now, if you have something with an expiry time, that looks much more like, let's have a vote. Let's see if this should happen. We have a time period where we're hosting an election, if you will. If they say they want this, it'll happen. If it doesn't, it's vetoed. And arguably, that's not good for Bitcoin. Arguably, we don't want to give miners that.
It's funny because having lived through and watched the block size wars, perhaps from as a less sophisticated participant. I think I and many Bitcoiners came away with the conclusion that nodes that users totally control miners.
Yeah,
and
the truth
what's funny is like
complex.
I don't. Yeah, like the more I get into, I'm like, this is not true. That's simply just how it played out in 2017. Well, kind of. Even if I would say Bitcoin Core had the veto, like the sort of Damocles over the other.
It's complex. Yeah. I think the correct answer here is it depends on the circumstances.
Yeah,
it depends on the type of fork. It depends on what you're trying to change. It depends on so many factors. And I think Segwit is a great example of this because Segwit was very special in that it activated, arguably, and I say arguably there, for user-activated software.
Yes, but we'll raise the flag and say user-activated software. This was one.
Yeah. So
everybody make your hats now.
Yeah. So what is a user-activated software? Well, first of all, I got to point out we have prior to Segwit, we'd already done user-activated softworks. And that was sort of in the Satoshi days, and soon after
the users were the miners, were the devs. It was all kind of the same.
No, that's not why. Okay. No, the reason why is. And God, I would have to look at the code and make sure I remember this correctly. But we had done bug fixes way back in the day. I believe what do they call it? BIP 50 or something. Anyway, the BIP that made sure that transaction IDs would always be unique.
Yeah,
I believe that would be an example of a user activated soft fork. I got to double check this, but I believe that's an example of user activated soft fork because we did it so early. The way activation happened was it just said after a certain block height, this rule was enforced.
Yeah, I think it was 2012 because this actually was a problem implementing Ordinals because of some transaction ID collisions in 2012. Yeah. Weird that I know this because of Ordinals.
Well, that would be a very serious example of it. Yeah. It's a real fuck up for databases. Like if there's one exception in Bitcoin mainnet where two transactions had the same ID.
No, I think we had one which was the same ID or
it does exist. There is this exception. It was very early on.
It was very unexpected too. Very low probability, and it happened right out the gate.
And I got to admit, technically our fix, people have realized since then it was actually incorrect. There's still a way that hypothetically in the future two transaction IDs could go collide. It would take a bizarre series of events. And it can't happen at the moment, but in the future,
it would be like bit flipping, like a flipping a bit or something.
So the fundamental reason why was that transaction IDs, they ultimately come from the Coinbase transaction. And the Coinbase transaction doesn't have a reference to the previous block. So if you had two blocks whose Coinbase transaction was the same, transaction spending from them could then be identical.
Okay.
And the reason why, it would take a remarkable series of events because you got to be able to then find a valid block with the same 32-bit nonce, which is not likely, especially these days. But in the past, when difficulty was lower, this was easier to happen. And the fix that isn't perfect, but nearly gets there, was we included the block height in the Coinbase data field. Now, that itself was a dumb idea. What we should have done is put the block height in the end block time field, which is a much more logical place to do it. But we screwed up. And then for very subtle technical reasons, in the future, there are block heights which could look like encodings of previous Coinbases in complex ways. And like if a miner mines something in just the right way, but it's not likely, but it could. And that's frustrating. But anyway, so there's that issue.
Yeah.
But from the user software point of view, the important thing there is you said we will release code that after this block height enforces this rule. And our assumption is everyone's going to go run this thing. And they did. And miners in that model don't have a say, because as long as users have installed the software, it is going to enforce that rule. And miners then basically get play a game of chicken. Have users installed the software? Have they not? And we did this with SegWit in a much more overt way, where we'd done this like BIP8, BIP9, whatever it was thing, where you have this sort of quote unquote miner vote. But then the user activated soft fork was people separate to Bitcoin Core released software that said after a certain point in time, you must quote unquote vote for SegWit to be activated or your block's invalid.
That's what I say. It's the sort of Damocles hanging over the head that says, I will cut your head off if you don't. But also, I know you're going to do that. But if you don't,
it's I will not accept your blocks unless SegWit has been activated and the SegWit rules are followed. That is what it is. Now, the thing with the user-activated software for SegWit was miners did turn on SegWit with respect to the non-UASF rules. Right? They did this before this deadline. So now the question is, did they do it because of UASF?
Yes and no. We don't know.
Yeah, we don't know.
We don't know.
And I think it's reasonable to say that what happened there was users said they might do a UASF. Miners did not know what percentage of users would do this. And they said, you know what, screw it. We don't want to cause a fuss. We don't want to find out the hard way that the UASF was successful. Also, we don't want to find out the hard way that it was only partially successful. Like, let's suppose I'm the only person in the world who runs a UASF client. Obviously, that doesn't matter, right? I'm one dude. My economic relevance to Bitcoin is minor. The UASF will fail. If you have a bunch of big exchanges, maybe that doesn't matter because maybe users will go trade coins otherwise, but maybe it does.
Yeah, if Coinbase does it all, the ETFs fall in line and yeah.
Or if you have a bunch of users saying, we don't care what the fuck the exchanges are doing, this is the definition of Bitcoin, and if you don't conform to that, we will not buy your coins. Because ultimately, that's where miner revenue comes from. Miners have to sell the coins to someone else who thinks they're real Bitcoin. And UASF is saying that someone else is only going to accept the Bitcoin if they follow certain new rules. You don't want to go down that path. You want none of these questions get raised and things to just work.
Hey, this is Will with Blockspace Media. And I don't know if you heard, but we just announced the second edition of our conference series, Op Next, now to be held at the MicroStrategy HQ in Tysons, Virginia.
That's right. After the success of our first scaling conference at Fidelity last fall, we're doing it again this spring, April 11th and 12th at the MicroStrategy HQ. I'm really excited for the programming. We have various stakeholders, industry, developers, and Bitcoin miners present.
So join us in April for open, neutral, and honest conversation about the leading proposals and technical solutions that will scale Bitcoin to the next billion users. No booths, no tokens, no shills, just Bitcoin and honest conversation.
You can find tickets and more information at opnext.dev or click below in the show notes.
So how do we solve the soft fork activation process? Is there a way it can be materially improved without...
The problem is it depends. Like, I'll give a hypothetical example. I
do want an opinionated example here in a second.
Let's suppose that we find a bug in the consensus.
Not a Luke witness data.
Yeah. Not some stupid bullshit. But let's suppose we have a repeat of I think it was in 2010, the inflation bug.
Inflation bug.
That was clearly a problem. We do not want to have a Bitcoin where we can create money out of thin air. And that actually is an example of UASF too, where people said that's obviously stupid. Someone, I think it was Satoshi, wrote code that changed the rules to make that block invalid. They said, obviously you should run this. And everyone obviously, turned that on. Because it's
within like a day.
Yeah. I mean, hours even. And in that case, no miner was not going to go run this because it's such an obvious, necessary thing. Now, in that circumstance, I think it would be totally reasonable to do a soft fork with no activation mechanism. Nothing more than, obviously, you should fix this. Look at this. This is clearly the thing we should do. Just run this code. And in that circumstance, I maintain a fork of Bitcoin Core. Obviously, I would, assuming I was awake, would download the code, double check it, add it to Libra Relay, and push release. It'd just be a no-brainer. And in that case, it wouldn't even be clearly as a UASF as it isn't, because so many people turn it on.
Everyone activated software.
Yeah. And the more up to speed economic actors, like Exchange as an example, would probably run the new code in a matter of an hour or two. Whereas it would just be something that's so obviously necessary. I mean, you might even run into an interesting scenario where in fact a bunch of people don't do it fast enough. And the result is not that Bitcoin doesn't change, is that they just lose money because they accept blocks that eventually people discard, right? And then, of course, in 2010, that is essentially what happened. You had a whole bunch of blocks that got reorged because by the rules everyone adopted.
It was a few hours reorg. Some people might say rollback, but it's technically a reorg.
Yeah.
They're kind of the same.
I mean, technically, from the point of view of the fixed clients, the blocks never happened.
Oh, yeah, that's true.
Yeah. Now, there's some nuance there, which, of course, obviously...
Unless they keep those blocks themselves.
A nuance here is, for a practical point of view, is if you install new rules, but invalid blocks are already in your database, you actually need to sort of remove them and go backwards. And in some cases, you can't do that. So some cases, you might have to, start your node from scratch, start it from a backup or an older state. That's a bit of a mess, but, generally speaking, it's pretty clear what needs to happen. Obviously, these are invalid blocks. We should never allow them. We'll just change that.
Yeah.
That is not so clear if someone, say, wants to promote opvault. Then it's saying, yeah, we have this opcode. It's good. It's important. Do I think opvault's a good idea? No. I think it's kind of dumb. It's not worth the change. If a lot of other people think it's a good idea, I'd probably run it anyway. But I'm not going to run it just because a couple dudes want it. And that's why no one has seriously released code that enables opvault, because anyone intelligent knows that it's obviously not going to catch on at this point. And someone could release code that has an activation mechanism for it, but chances are not many people would even run that code. It's kind of irrelevant. Now, what happens if Bitcoin Core adds it? I don't see how people don't run it if Core adds it. Well, one way they don't run it is people like me go and say, yeah, this is really stupid. You should run my code instead, which doesn't have this.
Yeah, but how many people are you? You got Luke, you've got Eric Vospel.
Depends on how stupid it is.
With LeBitcoin, you've got... then I can count the number of people who run their own forks that I know of on two hands.
Well, here's the thing. Opvault is not actively harmful. I don't like it, but I'm not going to say it will actually ruin Bitcoin. It's not that bad. If someone did something really dumb like drivechains, then you could be in a scenario where people do not enforce that rule because they think it's such a dumb rule. And then miners run it. Let's suppose, Antpool and Foundry and some others get together and say, all right, we're gonna do drive chains.
300 through the one.
Drive do 3,000. Yeah. 10 times better.
Yeah.
They go take a couple hits.
Yeah. Okay, bro, hit the go button.
Yeah, hit the go button. You could be in a position where they're enforcing this rule. Miners who don't follow that rule get But economic nodes say, screw this is stupid. And eventually the miners doing this either lose their hash power because people point their hash power at different pools, or they just give up. And now you could have a scenario where a bunch of money is tied up, protected by this fork that is not getting enforced. And in that scenario, a bunch of people would lose a ton of money. And this is why miners don't have full control. Like, it's not enough to say that miners fully control things, because hash power can change. If you have a fork that protects money, if you have a fork that coins can be spent if the fork turns off, that's a big disincentive to using it, even if it activates by the majority hash power. On the other hand, let's suppose you're talking about something like demurrage, which is totally different dynamics. Maybe miners could go force that, and then nodes would not want to do it. But this is stable, because if it turns off, all that happens is this tax goes away.
So let's wrap this up with the subject of demurrage. I will let you talk about it. For the listener, this is a bit of a sacrosanct, a bit of a heretical topic.
Not as heretical as tail emission.
Not as heretical as tail emission. I would say I'm very against tail emission because that's a supply change. But demurrage is a really interesting concept. Pitch it to I would say your average user.
So first I'll go pitch why we're talking about any of this, which is someone's got to pay for hash power. Obviously, if Bitcoin doesn't have people mining, it's insecure, right? Like, the reason why your coins are secure is because a ton of money gets spent on hash power. So that's just a given. One way to go pay with hash power is transaction fees, but that's not actually what pays for hash power right now. That's even with the hype of Ordinals, that was never a significant amount for any long period of time.
We damn sure tried, though.
Oh, you tried. But even with Ordinal hype, you were never in a position where, multiple days of blocks for transaction fees. It was all, a couple of blocks might be.
The peak was 2-month period where transaction fees on average over that duration were 10 to 20%, maybe on the high end.
Yeah.
With peaks, with several block peaks where it was multiples over subsidy. Yeah. But even then,
it was peaks.
The average for the entire year was 2% max.
Yeah.
Attributed, fee increase attributed to Ordinals.
So what is paying for mining?
Yeah.
Well, currently it's a tax on your savings. How do we implement that tax on the savings? Currently, by inflating away your savings. And at the moment, the value of that tax at current halving, last I did the numbers, it was roughly 0.5%. Right? So of the Bitcoin you own, roughly 0.5% of that value goes to hash power to keep it safe. Now, of course, you don't notice this because the Bitcoin price goes up and down, much more than 0.5%. 0.5% it's just noise. But that is real. If it weren't for that, you would have earned another 0.5% on the total value of your Bitcoin over the past year. Now it's probably gone up, 50% or something? So it doesn't seem to be a big deal. But in theory, this would matter if either that number were higher or the economy was much more stable. Now, from a technical point of view, it's very problematic if Bitcoin miners don't always have an incentive to make the next block. And the reason is because if I don't have an incentive to make another block, I might remine your block and take your fees. Now, if you have 1% hash power, you can't, other than exceptionally high fees, the chance of you being able to properly do that is essentially zero.
But as I approach, 30% is the magic number?
I mean, there is no one magic number, but as it gets higher, the chance of me mining 2 blocks in a row actually gets significant enough to make it worth it to implement code to reorganize the chain. And that by itself is not so bad. The problem is, the big miner, I'm the only one who can do it properly. Antpool can do this. Luxor can't. And what's going to happen in a world where this becomes common? Luxor's hash power disappears and they all go to Antpool, which we already have problems with variance. But it's doubly f***ed if there is no mechanism where you can make money. Like, at least in the current world, you could at least make an argument that, yeah, if Antpool does something evil, people could bite the variance and like get their hash power back. Maybe they'll use some insurance contract or something to fix variance some other way. Like, at least it's plausible you can fix this. But in a world where it is only transaction fees and transaction fees aren't perfectly stable, which they won't be, there's no way for that to happen. Because blocks are random, Antpool is going to be the one who's going to make the money. And that also provides them a strong incentive to go from like 30% to 50 or more, because now you're at the point where you definitely make money optimizing this. That is an ugly, ugly position to be in. Well, how do you avoid this? By making sure that fees are never that significant. Now, you need fees because you have to have some way of deciding who gets into the chain. That's just a given. That it's not reasonable to do it any other way. And indeed, if you try to avoid it, people can go pay fees anyway. But ideally, we want there to always be this incentive to make the next block. And the problem is there is no way to make fees spread out. All right? Like, people hearing this, they always say, well, we'll just pay out fees next 10 blocks. Yeah, but that's not how it works. The person who includes the transaction is the one who I need to pay off. And even if you say, well, fees have to be spread, I can always pay you out of band.
Yeah, it also kind of changes because we don't assume every block producer wants every transaction, because we could be in a future where the Bitcoin network becomes increasingly politically opinionated, and certain block producers include Russian transactions and others include American transactions. And how do you do that whenever you're talking about like actually?
And this gets back to how we have to have a world where you can make money at 1% hash power. Yes, variance is a cost. There are ways to go mitigate this, but like, if on top of these problems with variance, we also have, you just can't make money, we are totally screwed. And then the politics will matter so much more. That's when regulators start looking, well, I mean, everyone's forced to go to Antpool anyway. If we start regulating Antpool, they're not going to be able to go to somewhere else. And that's a dangerous position to be in. So
then that's why you say demurrage is a solution to this.
Yeah.
What is demurrage for the audience?
Well, in some ways, demurrage is the wrong term for this, because demurrage...
I've been pronouncing it wrong too.
So, probably. English is my second language, and I have no first language.
Okay.
But this comes from idea of, like, honestly, kind of kooky economic ideas that money should go and be volatile. You shouldn't be able to go save money, et cetera, et cetera. And it's just another way of implementing what inflation is. It's ultimately, inflation is a tax on savings. Now, why I would promote this is not because I think the tax is good, but rather it's the only way we have to ensure that miners consistently get income. And from a technical point of view, what you would do is you would say that when you spend a coin, you say that a certain percentage of this per year has to then go to a fund that then all miners gradually collect from in an even way. Basically you would say, like, every block you're allowed to spend, say, 0.1% or 0.01% of this thing, right? Take it so, like, you take whatever revenue you put in this, you divide it evenly over a very long time period so that miners always have an incentive to make the next block. That's what we'll pay them. Now, tail emission
is a supply increase.
It is right now. Technically, you can say it isn't actually because of how lost coins and all that work, but I think, that's getting into weeds. But I think the important thing to say is, no matter what you call it, ultimately all these things are just taxes. It's saying, if you want to hold coins, you're going to have to go pay a certain amount to keep the network secure. And currently we pay about 0.5%. My rough guess is somewhere between 1 and 0.1 is probably enough to make the system work. And, a way to think about this is, like, what percentage of your savings do you expect to pay to transaction fees anyway?
That's a good question.
Like, you wouldn't expect to pay 10% a year to transaction fees. That sounds absurd. Now, 1% per year to transaction fees, maybe, but you're probably not going to actually spend that. You'll probably spend a lot less, but you can afford something like 0.5% or 0.1%. And why do I say that? Well, humans don't live that long, right? Go compound 0.1% over like 50 years. It's like 20%. Are you willing to pay like 20% of your savings to making sure the savings are secure? That's not that much money, especially considering other economic fluctuations. And that's over an entire lifetime. Like gold storage fees are probably more than that for any reasonable amount of gold. Like
this, what's crazy is like you've thought about this a lot. I've heard various places where you argue or lay this out, and I've heard other people kind of talk about it. But it's crazy because like it's still just like an idea, and the difference between 0.1% and 1%, even though it's a small window today, when compounded, these are like massively different numbers. And now we have to like not just play, like not wear these hats just of developer or like Bitcoin consensus discussion, but now you have to imagine, you have to predict the future. You have to predict the future and predict that from an opinionated economic point of view.
Predicting the future isn't that hard. And why I say that is there's certain things about the future which are easy to predict. The thing I just talked about Bitcoin incentives becoming unstable and block reorgs becoming profitable. I mean, that's, ask any reasonably competent academic looking at Bitcoin from an unbiased opinion. They all say, well, obviously this is how it works. And it's like supply and demand. If you have supply and you have demand, there will be supply and demand, and there will be will be a curve of prices.
I don't knee jerk too strongly at either of those claims right now. So those don't seem wild to me right now.
Well, and I'd say like tail emission. So I touched on briefly earlier how tail emission doesn't actually result in an inflating supply. And this is another one of these like subtle mathematical things that I think people have a hard time understanding. And whereas, if you understand how the math works, you understand how the economics work, it's sort of like as obvious as gravity. If you're a physicist and I have a ball and I have like a curve that I roll the ball down, I mean, I can predict how fast that ball will be at the bottom of that curve very, very accurately. And tail emission, the influence on supply is like this too. Because with tail emission, you say every block will create a certain number of coins. And it's the same number of coins every block. Now, if it's the same number of coins every block, do you think that means that the supply increases without bound?
It depends where we are on the initial issuance of Bitcoin.
Well, right? We do this forever, right? Does the supply of Bitcoin increase forever?
No, it is a decreasing by percentage. It has a decreasing amount because
you're starting to understand this.
Okay.
So what's weird about tail emission is
if it's a flat tail emission.
Thing is, it interacts with lost coins, right? Because people lose coins as a roughly consistent percentage of the total value. Like, think of it this way. If you are...
That's a big assumption. You're assuming people lose coins at a roughly predictable rate.
Well, but the thing is, they lose... Like, the thing is, the number itself isn't what matters, right? Like, if you took Bitcoin and you made the numbers of Bitcoin such that the number of raw sats you had was multiplied by 10, like, let's suppose the protocol works differently, and that on all those numbers were multiplied by 10, the probability of you losing your coins in a boating accident doesn't change, right? The chance of you losing your coins in a boating accident is related to the value, the real world value, not the numbers.
Yeah, I see.
The number itself doesn't matter, which means that the rate at which people lose coins, the percentage lost every year, is roughly consistent. Now, obviously, that can go up a little more as wallets get better. That can go down a little more as wallets get better. It can go up a little more as wallets get less good. But, there's limits. Like, obviously, you're not going to lose 100% of your coins every year. That's ludicrous. All right? People aren't that dumb.
Unless you're the Ripple CTO in 2012.
Well, yeah. But, people just... Well, of course, that's actually the example of what I'm talking about. Of course, Ripple in 2012 isn't worth much.
Okay, I'm actually for demurrage if we just take Brad Garlic Breath's CTO's coins.
Well, we can't do that in a consensus algorithm because the math doesn't know who this guy is.
Yeah,
I don't know either, but the math doesn't know who
we should figure it out so we can.
But tail emission. I mean, Monero has. Now they did this for reasons related to their Blockspace algorithm, but it's just what's so inevitable about it was because this interacts with lost coins, the actual economic monetary base will converge to a stable number based on the rate at which people lose their coins. And the reason why is kind of like, imagine you have a bucket, right? I have a big bucket.
I'm imagining you have a bucket.
Yeah. I mean, there's a bucket over there. We can just grab it. It should be full of snow.
Yeah.
But, imagine we have a bucket.
Yeah.
So if it has a hole in the bottom and you fill it up with water, the rate at which water comes out of that hole depends on the amount of water, right? Because it's more water, there's more pressure pushing through that hole, and the rate increases. Now, if I take a hose and put a fixed amount of water in,
and you maintain the level,
I mean, level will converge.
Yes, this works in the scenario, but what if you are wrong and you have to tweak it again?
Well, I know so the amount of money that goes to miners in this scenario, it will converge towards how many coins people just lose by accident. That is how this works. Now, I'm not saying you might not need more security. It's possible you could make an argument you need more. But the key thing is the amount of coins people lose by accident is obviously an amount that's tolerable, given that they do it with fuck-ups anyway, and they keep on using it. So it's an affordable amount of money. It may not be enough to make Bitcoin work, but it's certainly something that's affordable. And demurrage is different in that sense, in that we have to actually pick a number. You have to write the number into the code.
It just sounds a whole lot to me like what ETH is doing with their kind of like firing from the hip, like burn mechanism.
But you got to understand.
We're gonna burn some coins, and that'll.
But the burn mechanism, though, anyone who's A, competent at the math, and B, is honest, can go look at that and say, obviously, there are scenarios where this is going to f*** up.
Yeah, it's already happened.
I mean, it's just obviously going to happen. Now, the ETH guys did anyway because they're kind of a bunch of scammers.
Holy shit! What are they doing over there?
Well, they're doing marketing.
Yeah, they're doing. Yeah.
Well, a funny story. So in 2014, I got invited to the ETH mansion in Switzerland.
There's a mansion?
Yes, with an elevator.
Wow.
Maybe in Switzerland, that's a totally normal home.
Yeah.
But, to me, it was a mansion. And I get invited.
You're not doing
there.
anything for the ETH isn't a conspiracy guys out there.
Well, so I got invited there to go stay there for a week. They were all, let's invite cool people. And so I go get there thinking, okay, this will be interesting. They're paying for the trip. So I went, I'm happy to go. I go show up. And it's the funniest thing ever because, it's this big building and it's this massive, like, wraparound glass on it. They've done the stupid marketing. There's like math equations all over the place. But no one actually there was a developer other than like maybe one or two people. They were all marketing. Like nearly everything at sort of ETH headquarters, which is marketing. Endless people doing like, oh, it's the next video we can do. What's it? Podcast we can do.
Hey. No, podcasts are an important part of Bitcoin consensus. I just did a podcast with Lynn Alden, and she said media is part of it. And I was like, yeah, that's right. There's also
you're talking to a guy whose real job is to go play dev on TV.
Yeah, I know.
Like I get it, but if your main thing is that you don't actually have technical like chops behind it.
That's true.
Obviously, it's a mess.
Yeah, especially at the genesis of one.
We're trying 2014.
Honestly, the marketer should come in once it's a more mature, established thing. Is you can go market it to marketing who are your exit liquidity.
Well, when I made open timestamps, I made open timestamps. My one bit of marketing was to pick a good name.
It's a very good name.
Maybe not that great, but it is a name.
I think it's a good name.
I got my domain name, and then that was it. I released it, and eventually someone said, you know what? Let's build a website for this. I was like, okay, build a website. I'll point to opentimestamps.org at it. And eventually someone comes up, and actually, roughly around the same time, someone else, let's make a logo. I'm like, cool. Send me your logo.
But are you telling me that you'd actually do anything? You came up with a name and ran a server, and everybody else?
Well, I wrote some code, which took me a few weekends. But, so much of the rest of it was just, I did something technically good.
Yeah.
It wasn't very hard, but it was technically competent. And a bunch of other people showed up and did the marketing for me.
That's
Not how it works.
Kind of what happened with Ordinals, except Casey spent a year building the client, and then the people, the frenzy flywheel.
Well, Ordinals, I think, is a funny example of this sort of build and they will come, because Ordinals is a piece of technology. It's fairly simple.
Yeah.
And it does one interesting thing. I'm not going to say it's useful, but I'm going to say it's interesting. And the way it's interesting means that you can do all kinds of very interesting marketing around it.
Oh, yeah.
And had Luke Jr. not freaked out about it, I think none of the marketing would have worked, and it would have just died on the vine. But because he created this feedback loop of outrage and marketing, then you could bootstrap this thing that was, it worked, but didn't do very much, into something a lot bigger.
I do remember I was hanging out with Casey and a handful of Ordinals enthusiasts prior to the blow up. It was really interesting. I was very interested in the numbering of Satoshis. I just think that's such a cool,
it's an art
Bitcoin, hobbyist thing. And I do remember the week that it blew up, because my life got very busy that week. And I do wonder, had there not been as reactionary of a response?
Well, of course, it wasn't so much Ordinals that did, it was inscriptions.
Okay, yes, I know. I used to differentiate.
Yeah.
I have found that it is almost no longer productive.
If it had always been Ordinals, I think nothing much would have happened. But inscriptions really pushed Luke Jr.'s buttons, among others, and that's got the marketing game going. I mean, I at one point would have had inscription number probably 4,000, 5,000 or something.
Yeah.
It's a question once I saw an easy way to make one. Cool, I'll go stick the Open Timechain logo.
Yeah. You should have done it. Been so cool. But,
I inscribed it to Satoshis that went to the Open Timestamps, one of the Open Timestamp servers donation.
Okay, cool.
So that eventually got spent off in the fees.
Oh, yeah.
Yeah.
Okay, I feel like we've talked enough. We've covered many, many things. Again, this conversation kind of happened off the cuff. No structure. I really enjoyed this, Peter. Picking your brain, going down the soft fork rabbit hole, not being afraid of esotericisms. What's your message to the CoinDesk audience listening, maybe who made it through this? Maybe they fell asleep, or maybe they forgot they're listening to the background.
Don't pick the day I did to come to Oklahoma. I mean, I'm asking you to predict the weather, but, turns out -16 with a bunch of snow is not something you guys know how to drive.
It sucks, man. This is not supposed to happen. You Canadians brought the frigid weather with you.
We went off to the mining facility with my phone taking photos of all the people every couple hundred meters who had gotten off the edge of the road.
Yeah. Yep, we got 3 salt trucks for the whole city, and
you're just shit at driving.
Not me, everybody else.
Everyone else.
Well, okay. On that note, Peter, thank you so much for coming on Bitcoin Season 2. And make sure to check us out wherever podcasts are streamed. See you all next week.